Philip Futures. Today, I'm going to present to you an outlook for the Chinese economy and its implication on the commodities market. Disclaimer: information presented is only for the purpose of investor education. Agenda for this session. We will first look at China weak economic data. Then, with this backdrop, we will discuss China responses. China responses provide an opportunity. Although we cannot participate in their closed equity market, we can participate in the commodity market using futures contract as a proxy to capitalize on this opportunity. The following is a series of charts which shows you that China economy is slowing. This is China benchmark equity market index, the Shanghai Composite Index. It has been in a downtrend since 2009, making lower highs and lower lows. At this point in time, it is negotiating the critical support level at 2000, which is also the low in the last 3 years. The stock market reflects the economic health of the country because stock prices reflect corporate profitability, which in turn is dependent on robust economic activities. Weakening of US dollar against Chinese renminbi is not helping the Chinese economy. US is China's largest trading partner. Weaker US dollar translates to expensive Chinese exports, which in turn reduce the export demand of China. As you can see from the downtrend of this dollar renminbi chart, US dollar has been weakening since 2 years ago. China GDP growth dropped to 7.6% in second quarter 2012. The previous year-on-year peak growth was at 11.9% in first quarter of 2010. The reading 7.6% growth marked the slowest year-on-year percentage gain for the past 2 years, and this indicates a continued downtrend in the economy. Since the escalation of the Eurozone crisis in 2010, China is trying to engineer a gradual slowdown in their manufacturing sector, as illustrated by the gentler slope on the PMI chart from 2010 till now, compared to the steep fall in 2007. For the month of September, the official Purchasing Manager Index, PMI, registered 49.8 in September, from the previous peak at 53.3 in April 2012. September number is the second straight reading below 50, indicating declining manufacturing activities. There's increasing pressure on Premier Wen Jiabao to reverse the slowdown ahead of the transfer of power to a new Communist Party leadership that begins later this year. The same can be said for industrial production. The effort by China to engineer a gradual slowdown is apparent because you can see a gentler slope on the industrial production chart from 2010 till now, as compared to the steep drop during the last financial crisis in 2007. China announced that industrial production increased 8.9% in August 2012 from a year earlier. This is slower than the growth of 9.2% in July 2012. After the announcement, President Hu Jintao said that the economy faces notable downward pressure and suggested that more stimulus are in the pipeline, and they are in the form of railway and road infrastructure projects. Foreign direct investment, FDI, is direct investment into production in China by foreign companies. FDI is different from passive investment, which is investment in the securities such as stocks or bonds. Foreign direct investment in China actually fell in August 2012. As you can see from the chart, it declined 1.4% from a year earlier, the ninth drop in 10 months. This might indicate that confidence in the nation's growth among foreign investors might be waning. You have seen the weak economic data from the previous charts. Part of the reason for those weak data is due to slowing global economy, no doubt about it. But the desire to curb property prices and inflation by the Chinese government also played a significant role. They were caught in a difficult situation a few quarters back when they were faced with a stubbornly high inflation, overheated property prices, and slowing external trade. It is a catch-22 situation, and they have chosen to clamp down on property prices and inflation rather than spurring economic activities then. However, things are changing. China Consumer Price Index, CPI, rose 2% year-on-year in August 2012. This is far below the 6.5% spike in CPI in August 2011. China Producer Price Index, PPI, is also telling the same picture. PPI, which measures inflation at the wholesale level, slumped 3.5% year-on-year in August 2012. This is far more comfortable than the 7.5% year-on-year spike in August 2011. This drop in inflation rate allows greater flexibility for Chinese government to adopt easy monetary and fiscal policy in a slowing economy. To stabilize housing prices, China's central government reckoned that it is important to increase the supply of homes in the market. First-tier cities like Guangzhou, Hangzhou, Beijing, and Shanghai are going to increase land supply. Chinese policymakers are hoping that growing home supply would help cool home prices. This is a policy that is demand-friendly to the commodity markets. Now that inflation rate is much lower, there's greater flexibility for Chinese government to adopt easy monetary and fiscal policy in a slowing economy. That is exactly what they did. Compared to Eurozone and US, they have no financial muscle. Their political skirmishes render them ineffective. On the other hand, China has the financial muscle. She has the political environment to be nimble and the social legitimacy after keeping inflation under control. In China, interest rates decisions are taken by People's Bank of China Monetary Policy Committee. The PBOC administers both 1-year lending and 1-year deposit rate. China cut benchmark interest rate in both June and July to allow banks to offer bigger discount on their borrowing costs. This served to reverse the slowdown in the world's second biggest economy. Compared to US and Eurozone, China's current interest rate of 6% is a comfortable level for People's Bank of China to reduce the borrowing costs, thereby spurring investment. This is a chart of China Reserve Requirement Ratio. Reserve Requirement Ratio is the liquid assets that People's Bank of China mandates that banks keep at all times. The adjustment of this ratio regulates the money supply in the market. Current Reserve Requirement Ratio of 20% gives much capacity for the banks to lend, thereby increasing money supply in the market. Easy money supply will have a positive impact on the commodities market because easy money supply lower borrowing costs, which induce fixed asset investment, increasing demand for commodities. Looking at foreign exchange reserve chart. Foreign exchange reserves are assets of the central bank held in different reserve currency, mostly the US dollar, and to a lesser extent, the euro, the sterling, the yen, and gold. Foreign exchange reserve is an important indicator of the ability to repay debts. It's also a critical consideration if the country wants to adopt easy fiscal policy. Global economy is slowing, and export demand is dropping in China now. This is not a new problem faced by China. In fact, during the financial crisis in 2009, export demand collapsed. China has a long history of driving economic growth through public investment. When external trade flatters, we do not need to look very far back into history for an example. After Lehman Brothers' collapse, the Chinese economy was hit by a decline in exports. Chinese government responded with a 4 trillion yuan stimulus package to revive economic growth by focusing on infrastructure construction. The massive stimulus helped create millions of jobs within just 2 quarters and revive the economic activities. Part of the stimulus was used to develop China high-speed railway. A section was also set aside to rebuild areas damaged by the Sichuan earthquake. It was also used to build the Qingdao-Haiwan Bridge, the world's longest sea bridge. The infrastructure boom also led to the creation of cities like the Thames town. Fast forward to current economic climate. This is a chart of China external trade. The blue line is import growth, while the orange line is export growth, year-on-year percentage change. China imports shrunk unexpectedly in August 2012, in a sign that its economic slump is worsening. Imports declined 2.6% from a year earlier, well below analysts' expectation for positive growth. On the other hand, China exports rose in August 2012, but by only 2.7% from a year earlier. These readings were down from a double-digit growth of recent years, as Europe debt crisis and a sluggish US recovery hurt demand for Chinese goods. China also suffered badly on their external trade sector in the last global financial crisis. As global demand for Chinese products waned, the government spent heavily on infrastructure to boost economic growth. If Eurozone debt crisis were to escalate into a global financial crisis, the Chinese government is likely to adopt the same fiscal policy again. It has served them well in the past and will likely tide them over the next crisis as well. This is a chart showing contribution to GDP growth by external trade, consumption, government spending, and investment. In the last financial crisis, when external trade collapsed, the grey bar collapsed. Government spending, the blue bar, jumped significantly to pick up the slack. Fixed asset investment refers to spending on buildings, equipment, roads, and railway that help in the production of goods and services. Easy fiscal and monetary policy during the last financial crisis led to a boom in fixed asset investment. Chinese government spent their way out of the previous slump, and they are doing it again in the current downturn, although in a smaller scale now. In early September this year, Chinese government announced plans to build highways, railways, and water treatment plants, estimated to cost about 1 trillion yuan, 2% of their GDP. The projects are beginning in the coming months, and the impact will likely be reflected in fourth quarter GDP of this year. China responses provide an opportunity. Although we cannot participate in their closed equity market, we can participate in the commodity market using futures contract as a proxy to capitalize on the opportunity. Some say copper has a PhD in economics because copper is used in everything from electrical wiring to water pipes. It is seen as a good measure of the economy. If the economy is improving, it will likely translate to greater demand for copper. The National Development and Reform Commission of China, NDRC, announced that it approved railway and roads project. To curb home prices, China is also trying to increase the supply of homes. Adding home supply and improving urban infrastructure increase the demand for copper. This chart shows both Shanghai Composite Index and copper prices. The last stimulus package brought about a boom in copper prices in 2010. And copper has spiked up in recent weeks after the announcement of the latest stimulus project. The strength in copper upward movement suggests confidence in the impact of the stimulus project on the Chinese economy. China's demand for rubber is not difficult to understand. Increasing infrastructure development, higher intensity of urbanization, greater vehicle sales all contribute to larger demand for rubber. In fact, rubber industry is very dependent on the health of China's economy. The investment amount approved for the project is estimated to be about 1 trillion yuan. Although the amount is a much smaller amount compared to the massive stimulus of 4 trillion yuan during the 2009 financial crisis, it is also likely to be helpful in spurring economic growth in China, thereby driving rubber demand momentum. In this chart of Shanghai Composite Index and rubber price, you can see that both of them generally move in tandem to each other. The last stimulus package induced buying, pushing rubber prices higher. The positive outlook on Chinese economy after the stimulus project will also likely translate to higher rubber prices. Asia, especially China, is currently the dominant user of crude palm oil. Up to 75% of crude palm oil production ends up in the food industry, being used in cooking oil and margarine. The other 25% is used in shampoos, animal feeds, cosmetic, and as a biodiesel component. This is a chart of Shanghai Composite Index and crude palm oil prices. Crude palm oil prices found a bottom in early 2010 after the introduction of the previous 4 trillion stimulus package in 2009 during the financial crisis. Economic activities brought about by the current stimulus project will likely spur the demand for crude palm oil in its various usage in the near future, supporting crude palm oil prices. In conclusion, we have seen that economic data from China has been weak. This prompted Chinese government to respond with easy fiscal policy, which is their tried and tested strategy. They have a long history of driving economic activities through public infrastructure spending when external trade flatters. The side effect of large-scale public infrastructure spending is greater demand for commodity, which in turn might translate to higher prices. Are you ready to capitalize on this policy change from China? This is the end of my presentation. I'm Han Qiang, investment analyst from Phillip Futures. Thanks for your kind attention.